Hello, and welcome. It's LC Terry, the founder of Money and Me 360, your transformational coach that's not only going to teach you how to manage your personal finances, but also how to create the life that you really want. Okay, so I hope you got my memo. I hope you're ready for this video because we are going to be talking about for the next 3 weeks. I may stretch it out to 4. We're going to be talking about how credit works. Okay, so we all know about credit cards. We all know that we can get loans, and we can get car loans and mortgage loans and any kind of loan, you name it, we can apply for credit to get it, okay? But how many really know the inner workings of how their credit is scored? How many really know the inner workings of how credit really works? Okay, so that's what we're going to be talking about over the next 3. I may throw in a bonus week. But definitely over the next 3 weeks, we're going to be talking about credit. I'm not going to assume that anyone knows anything about credit. I am a certified credit coach. However, this is not about selling credit repair. This is simply about me empowering you on how credit works. So the information that I'm going to share, I would tell you to share this video, but guess what? You're a part of my exclusive Facebook group, which means no one else can see this video, which also means no one else can see the questions that you ask. So I encourage you to invite your friends, your family to this group, this closed group, this private and exclusive group, so that they can learn about credit and budgeting and how to save and how to do just different things when it comes to the business of life. So in this series, we're going to talk about credit, okay? I'm not going to assume that anyone knows anything about credit because I can't stand when people are teaching or lecturing or sharing knowledge and they start here somewhere and everyone else may be here, and so you kind of lost in between. So I'm going to level the playing ground and we're going to start from ground zero talking about credit. So maybe some of the things that I'm going to share you already know about, and maybe you don't. So I'm excited about sharing. We're going to jump right in. So when it comes to credit, credit is a part of our financial power. We would all love to be able to pay for everything in cash. But sometimes in life, it calls for us to maybe take out a loan, such as for houses or cars, or maybe use a credit card when we need to use a credit card. Okay, so sometimes credit is somewhat a need instead of a want, okay, if we can't pay for something in cash. So credit is a part of our financial power, and how we take care of our credit profile, how we take care of of building our credit score can really impact how we have access to certain financial tools such as credit cards and mortgage loans or whatever type of loan you may need, because which we'll get into as well, how the credit score and what the range is. So if you have a higher score, then you are susceptible to better rates. If you have a lower score, then you're charged more for interest, okay? So we want to be sure that we take care of our credit profile, take care of our credit scores to the best of our abilities. Okay, so working to improve your credit helps to ensure you'll qualify for loans when you need them. Okay, so first, what is credit used for? A credit score is primarily based on a credit report, your personal credit report. So information typically is really sourced within the 3 major credit bureaus, and oftentimes people think that there's only the 3 major credit bureaus, but there are multiple credit bureaus. But the 3 major ones that's used is Equifax, TransUnion, and Experian. Okay, although there are other bureaus that are used. Okay, so these, when you go and apply for a loan, these particular credit houses are scoring how you manage your debt and then placing a value on it, which is called a credit score. Okay, and so the people who manage those credit profiles are TransUnion, Equifax, and Experian. Those are the 3 main bureaus that most lenders use when they're determining whether you qualify for a loan or not. Okay, so let's move right along. So although there are more bureaus, those are the 3 major ones that the that the lenders will use. Okay, so what are the different types of credit? So there are two different types of credit. There is revolving credit and installments. Those are the types of credit lines that are on your credit profile. There are two. So once again, that's revolving and installment. So if you're at a lender and they say you don't have enough revolving debt, that's simply saying that they're taking a look at your credit card. So revolving debt is the type of debt that doesn't have a fixed end date, which is like a credit card. Okay, not like a credit card, it is a credit card. So a credit card doesn't have an end date. You just pay it monthly, or you pay it off monthly, and then it's the gift that keeps on giving. You can keep using it continuously. But installment loans are a little bit different. Installment loans are things that have an end date to them on your credit report. So an installment loan, an example of that would be a car note, would be a mortgage, because it has an end date. When you took out that loan, they gave you an end date. Okay, you have a 15-year fixed mortgage, meaning in 15 years, if you make the payments we asked for, this house is paid off. Or when you go for a car loan, okay, you have a 48-month car loan, meaning in 4 years, if you pay on time, this car loan is paid off. Okay, so that's an installment loan. They give you an end date. But with a revolving account, there is no end date. You just continue to use it, which is a credit card. Okay, so what is the credit score range? Your credit score range can range anywhere between 300 to 850. Okay, and your credit score has 5 different categories, and we're going to jump right into this. So you have payment history, utilization of total debt, length of credit history, inquiries, your credit mix. Those are the 5. So once again, it's your payment history, your utilization. So anytime you hear someone say you have high utilization, they're simply saying you have a lot of debt, okay, that you've ran up on your credit report. So anytime you hear someone say you have a high utilization in your credit profile, they're simply saying you've used a lot of money on your credit. Okay, so you have a lot of debt. Okay, length of credit history is number 3, inquiries, and then your credit mix. Okay, so those are the 5 things that make up your credit report. Each one of those 5 categories is assigned a percentage within your credit report. All 5 do not hold the same weight. Okay, and we're gonna go into that. So sometimes you might be wondering, I've been paying my bills on time and my score isn't going up like it's supposed to. You might be looking at, or you may be saying, I had some inquiries fall off of my credit. Why didn't my credit score go up? Well, inquiries have its own percentage within the credit bureau, within your credit report. And that's for every single bureau. So TransUnion, Equifax, Experian, they all have this same percentage. And I'm going to tell you what the percentages are so that you have a better knowledge of what it is when you're applying for debt and you hear these terms. Now you'll be able to say, oh, okay, that's what that means. Okay, so moving right along, payment history. I'm going to go in order for the 5 categories that are on your credit. Payment history is 35% of your credit score. 35%. So if you're making late payments and you're not paying on time, guess what? That accounts for 35% of your credit score and within your profile. Did you know that? Now you know. That accounts for 35%. So every time you make a late payment or that's showing up and it has a heavy weight, keeping in mind that it's out of 100%. So picture a pie chart, picture 35% is your payment history, okay? Second in line is utilization. So when you hear someone say utilization, they're talking about how much debt you have, how much debt you've used up. That accounts for 30% of your credit score. So if, for instance, let's say you have $10,000 worth of credit within your credit profile and you've used up $9,000, well, guess what? Your utilization is high, meaning your debt is high because you owe, did I say 9,000 out of 10? Let's say you owe $9,000 out of $10,000 as a collective amount for your entire credit report. Well, you've used 9,000, so that's what utilization is, how much you've used. So credit utilization counts as the second biggest component, which is 30% of your credit score. So your credit utilization a rate is based on how much of your available credit is being used, and it only considers revolving debt. So when you hear people talk about your credit utilization, they're talking about your credit cards, which is your revolving debt. Okay, and how that revolving debt works is if you keep your utilization under 30%, then you're going to see most likely see a raise in your credit score. So you always want to consider keeping your utilization under 30% for all of your credit cards. So for instance, if you have a credit card and that credit card has a $100 limit, only use $30 or below, because 30% of 100 is $30. Okay, so if you don't know how to calculate 30%, I'm going to tell you right now. Take whatever the amount is of your credit limit and multiply it by 0.30. Whatever that number is how much you should not go over on your credit card. So if you have, oh no, let me do some math. Let's say you have a credit card that's $1,500. Take out your calculators. We're going to school. And you know that LC Terry told you to keep that credit card under 30%, but you don't know how much 30% is. We'll take 1,500 times 0.30, because 1,500 is our credit limit for that credit card. 0.30 times 1,500 is $450. I don't care what happens, unless it's an emergency. Don't go over $450 for your $1,500 Target credit card or MasterCard. Okay, don't go over $450, because that's going to contribute to your utilization. Okay, so that's how you calculate your utilization. Third in line for your credit report is the length of history. So the third most important factor is the length of history. It makes up 15% of your credit score. So history is the average of all of your accounts that you have. So everything that's in your credit report, whether it's a car loan, revolving debt, car loans is of course an installment loan, but let's say it's your revolving debt as well. It's everything in your credit profile makes up your credit history. So let's say, and then it's the average of that makes up your credit history. So let's say you go to get a car loan and they say you don't have enough credit history, we're not able to approve you. What they're simply saying is you don't have enough time where we've been able to see how you pay things off. You only have a credit card that you've only had for 3 months. You have another credit card that you've only had for 1 year. So putting those two together and averaging them out, you really only have about 8 months worth of credit history. Okay, so that accounts for 15%. So if you have a short credit history, more than likely it's going to be a little harder to get a loan, or if you do get a loan or if you do get a credit card, you're probably going to pay a high interest rate. Okay, so that's the length of history. Okay, fourth in line is your credit mix. I'm trying to keep this video to 15 minutes and we're almost there. We're cooking with grease, guys. So fourth in line is your credit mix. So your credit mix accounts for 10% of your credit score. Okay, so it refers to the types of account that make up your credit report. It can be revolving or installments. So if you ever hear someone say you don't have enough credit mix, that's what they're saying. You probably only just have a car loan. They want to see how you handle debt with different types of debt tools. They want to see, okay, yeah, you're paying a car note, but that's all you have on your credit. How would you handle a car note and a credit card? That's what a credit mix is. They want to see how you handle revolving debt and how you handle installment loans, all on your credit report. Okay, so that accounts for 10%. And finally, the last category is inquiries. So this is where everyone kind of gets a little mixed up as well. Inquiries make up 10% of your credit score. And when